As the U.S. markets are now closed, SoundHound AI Inc., trading under the ticker SOUND, finished the session on Wednesday, September 24, 2025, at a price of $17.98. This marks a slight downturn of about 0.39% for the day. While a minor daily fluctuation like this might seem insignificant, it's the broader context that demands our attention. The common narrative paints SoundHound as one of the quintessential high-risk, high-reward plays in the artificial intelligence space, a stock that has delivered astronomical returns and equally gut-wrenching volatility. Many investors, perhaps looking at their positions through platforms like Robinhood or SoFi Invest, see a company that's riding the massive wave of AI adoption. The expectation is that its pioneering work in voice AI will inevitably lead to market dominance and a soaring stock price. However, the reality on the ground is far more nuanced and complex, suggesting that the path forward is not a straight line up, but a challenging climb filled with significant obstacles and intense competition. The daily trading action, with a volume of over 18.5 million shares, hints at this underlying tension between the optimistic vision and the operational realities the company faces. Let's dissect the recent activity that's fueling this debate among investors, from those executing trades on professional-grade platforms like Interactive Brokers to those utilizing the automated investing features of Schwab Intelligent Portfolios. The stock has been on a tear recently, posting a staggering 48% gain over the past month. This surge wasn't arbitrary, it was largely ignited by a significant partnership announcement with Red Lobster. SoundHound will be deploying its AI-powered voice assistant to handle phone orders across the restaurant chain's locations. On the surface, this is a massive win. It's a tangible, real-world application of their technology with a major brand, validating their business model and showcasing the scalability of their solution. The market's reaction was euphoric, sending the stock climbing. This news fed directly into the prevailing expectation. SoundHound is successfully penetrating the lucrative restaurant and customer service sectors, and this is just the beginning. It's the kind of development that makes self-investing seem straightforward. But reality checks in when we look closer at the numbers and the sentiment beneath the surface. While the Red Lobster deal is a fantastic proof of concept, the financial implications need to be scrutinized. The company's most recent earnings report for the second quarter of 2025 was by all accounts a blowout. They reported a record $42.7 million in revenue, a 217% increase year over year, handily beating analyst expectations. They even raised their full-year revenue guidance to a range of $160 to $178 million. This is the kind of top-line growth that gets investors excited and reinforces the bull case. It appears to be a clear signal of hyper-growth. However, when you dig into the earnings report, you also find a GAAP net loss of $74.7 million. While the non-GAAP net loss was a more palatable $11.9 million, the company is still burning through cash as it scales. This is the central conflict for SoundHound. The expectation of explosive growth is being met, but the reality of profitability remains distant. The high price-to-sales ratio, sitting at over 50, indicates that the market is pricing in immense future growth, leaving very little room for error. Any slowdown in this trajectory could lead to a severe re-rating of the stock. This is where the conversation on platforms like Fidelity Investments becomes critical, as seasoned investors weigh potential against performance. The institutional ownership picture adds another layer of complexity. Around 613 institutions hold positions in SoundHound, with major players like Vanguard and BlackRock among the top shareholders. This provides a certain level of validation. However, recent filings show a mixed bag of activity. While some institutions have been increasing their positions, others have been trimming. For example, Bank of America significantly increased its stake, while Morgan Stanley reduced its holdings. This divergence suggests that even the so-called smart money is not uniformly decided on SoundHound's long-term prospects. They see the promise, but they are also acutely aware of the risks. For the individual investor managing their portfolio, perhaps through a Fidelity brokerage account or even exploring Fidelity mutual funds, this institutional indecisiveness is a crucial data point. It tempers the exuberant narrative with a dose of professional caution. So, what exactly does SoundHound do? At its core, the company is a leader in conversational voice artificial intelligence. Its technology allows machines to understand and respond to human speech. The applications are vast, spanning across automotive, where they partner with car manufacturers to create in-vehicle voice assistants, to the restaurant industry for automated ordering and customer service for enterprise clients. Their Houndify platform is a key offering, allowing other businesses to integrate this advanced voice AI into their own products and services. The business model is multifaceted, relying on licensing fees, subscription models, and usage-based revenue. A crucial part of their strategy is moving towards a transaction-based model, particularly in the restaurant space, where they take a small cut of each order facilitated by their AI. This is a powerful model if they can achieve scale, as it creates a recurring and growing revenue stream. They have made significant strides in diversifying their customer base, a critical move to de-risk the business. A few years ago, a small number of clients accounted for the vast majority of their revenue. Now, no single customer represents more than 10% of their sales, a much healthier position that demonstrates the broadening appeal of their technology. Looking ahead, the future outlook for SoundHound is a study in contrasts. The bull case is compelling. The total addressable market for conversational AI is enormous, and SoundHound has established itself as a key player with proven technology. The recent acquisitions, like that of Interactions Corp., are expanding their capabilities into more advanced agentic AI, which could unlock even larger revenue opportunities in the digital labor market. The company's backlog of business, a measure of future anticipated revenue, stands at an impressive figure, suggesting a strong pipeline of deals. Analysts, for the most part, remain cautiously optimistic, with a moderate buy consensus rating. They see the growth, the technological edge, and the expanding market. However, there are significant risks that cannot be ignored. The primary concern is valuation and the path to profitability. The stock's high beta of over 3.0 indicates that it is significantly more volatile than the broader market, making it a risky proposition for those with a low risk tolerance. Furthermore, the AI space is incredibly competitive. While SoundHound has carved out a niche in voice AI, they're indirectly competing with tech giants like Google, Amazon, and Apple, who all have their own voice assistant technologies. There are also smaller, more specialized competitors vying for market share. The macroeconomic environment also plays a role. Higher interest rates and economic uncertainty can make investors less willing to bet on growth-stage, unprofitable companies like SoundHound. Any sign of a broader economic slowdown could impact their clients' willingness to invest in new technologies, potentially slowing down SoundHound's growth. Here's a question for everyone watching. How many shares of AI-related stocks like SoundHound AI or even NVIDIA stock and Apple stock do you hold in your individual brokerage account? Comment below and let's get a sense of the community's exposure to this sector. It's a fascinating landscape, with different approaches from active trading on Robinhood to long-term holds in Fidelity IRAs. In conclusion, the story of SoundHound AI is the quintessential tale of expectation versus reality in today's market. The expectation is that of a disruptive AI leader on an unstoppable trajectory, a narrative fueled by impressive revenue growth and high-profile partnerships. This view is what has driven the stock's incredible performance over the past year. The reality is that of a company still in its early stages of monetization, facing a long and uncertain path to profitability in a fiercely competitive market. The valuation is stretched, and the stock is prone to wild swings based on market sentiment. The recent deal with Red Lobster is a tangible step in the right direction, but it is just one step on a very long road. For investors, the key is to look past the hype and understand the fundamental trade-offs. This isn't a simple buy-and-hold story without caveats. It requires a deep understanding of the technology, a close watch on the company's execution, and an acceptance of the significant risks involved. The disconnect between the exciting, forward-looking narrative and the current financial realities is where the true analysis lies. It's not just about the technology, it's about whether the business model can ultimately translate that technological prowess into sustainable, profitable growth. That remains the most important unanswered question for SoundHound AI.